Hi, everybody. It's Jessica Stone at Stansberry Research, and I reached Brian Tycangco, our True Wealth Opportunities China analyst, because we just saw a decision by the White House to basically ask a federal pension plan to divest from Chinese equities, which of course would have implications for all of the federal employees invested in that. But part of the rationale here, Brian, is the recent spate of fraudulent IPOs that we've seen in China, places like Luckin Coffee, which has just terminated its CEO and COO. And I'm wondering, from your vantage point, does the US government have a point? Is it indeed an investment risk, if not a national security risk, to be invested in these Chinese equities?
With regards to national security risk, it's really hard to ascertain which companies they're talking about and how this investing in Chinese equities could do that, because the two companies that they've actually highlighted the most that contain national security risks are actually private companies like Huawei and DJI. With regards to the fraudulent IPOs,
I mean, do they have a point there? Because obviously some people have lost a lot of money by being
of
invested
course,
in companies.
Of course, and in any investment, people have to always be careful and do proper due diligence. It's really difficult to throw away the entire harvest just because of a few bad apples, so I would say. And with regards to companies like Luckin, if you did your due diligence, you would find out that yes, this sounds a little bit too good to be true. Point in case, nearly one third of the entire market cap of the US stock market, that's $30 trillion. One third of that is attributable to foreign companies listed in the US. And a lot of these companies, have their own accounting standards. So as investors, if you know that you're going to be investing in foreign companies listed in the US, it is your duty to do your own due diligence and do your legwork and do your own research. The reality is Chinese companies listed in the US have already attributed $1.5 trillion to the US total market cap. And they have added hundreds of billions of dollars in new market cap from share price increases over the past few decades. That includes companies like Tencent Holdings, that is up 16 times over the past 10 years. Alibaba, up something like 100% over the past 5 years. So these are huge companies, and investors in the US have benefited greatly from having access to these companies in the US. So you can't just write that off because of a few small bad companies.
You would say that the federal employees who are now not going to have access to these investments are really going to lose out.
Chinese equities have been the best performing set of equities globally since the start of the year. The MSCI World Index, which is everything in the world, is down something like 13% so far this year, whereas the MSCI China Index is down just 4.5%, making it the best performing market in the world compared to an almost 9% drop in the S&P. And this letter about the government retirement savings plan, the Thrift Savings Plan, pulling out from Chinese equities, talks about reallocating that money from an emerging market index that includes China to something that doesn't include China. Instead of losing 16%, you would have lost 23% if you didn't have China in your portfolio.
Well, I want to ask you too about the broader implications for the economic recovery, because we know that China and the United States are linked. And so even though this is in the investment bucket, if you will, not the macroeconomic bucket, the sort of tension that increases as a result of this kind of action, especially after China had just lowered tariffs on a bunch of US goods that had been caught up in the trade war.
I think this move is for the most part symbolic. I don't think that the majority of the investment community is going to give it a lot of weight. It is concerning that they are pushing for this because the government the government retirement savings is going to be the one at risk for this. And let's say you're a government employee and your retirement savings are invested in this particular plan, and it grossly underperforms the rest of the market. How would you feel? I mean, would you want the government to make up that difference? And at the end of the day, who would pay for that difference? My take on it would be the taxpayers. The taxpayers would have to subsidize the difference of that because of a bad decision the government made in not investing in what everybody else thinks is a good investment.
Yeah, a lot of implications here. Well, Brian Tycangco, thanks as always for your insights on this. And if you would like to see much more content with Brian or any of our other analysts, but especially with Brian, we'd love for you to subscribe to our YouTube channel. And you can also find us on Facebook, Instagram, or Twitter. Thanks so much for watching. That's all for now.